2025 in storage. We're going to go over what this year meant because it was huge for self-storage, a transitionary time. But we're also going to break down what we did at the firm. I'm talking about buys, sells, and why. Welcome everybody to Self-Storage Income. Connor, you ready to do this, dude? 2025, man.
So
it's
ready.
Almost over.
Yeah, no, 2025, totally insane year. A lot of things happening, a lot of changes going on in the markets. I mean, you're talking deal flow, valuations, opportunities, all these things going on. And I'm so excited to share with everybody, behind the scenes, how all this stuff happened for us here in the firm and for you guys at Cedar, how all this stuff just played out, how you guys are capitalizing on opportunity, shifting things around to be able to, go out and capitalize on not only the opportunities that happened here in 2025, but like we've been talking about 2026, what has yet to come, and how you guys have positioned yourselves now to be able to move into 2026 with some incredible opportunities.
Including talking like strategically valuations, how we're valuing. What's the difference between selling, refining, and buying? And how do you decide? Is now the right time to buy? Is it to sell? Is it to refinance? Like, what are the things that go into that? And this has never been more important because, the last 3-4 years for storage has been really hard, right? Like basically a recession, harder than 2008 in a lot of ways. Huge rate drops and stagnant markets. And that has accumulated to 2025. And 2025 marks the change. And we saw that as we went through this year. And what that means for this industry, for these assets, is really, really big. And a lot of people in the market have left. These last 3 years, they didn't make it through. They're gone. That has created opportunities that we haven't seen in 15 years. And at the same time, the ones that are here, the ones that are buying in, they're now prepping for the next run like we had seen before. And that's really exciting to me.
Yeah, no, it really is because, again, we talk about it, it's always a great time to get into storage, right? But times like these when you
are unusual.
Oh my gosh. Yeah, because, you said about 15 years ago was a similar time frame.
Yeah.
Would you say, what makes it similar? How would you compare those time frames? What do you mean by that?
Yeah, so after the Great Recession, right, we were buying deals under replacement cost. We're getting opportunities. Now, let me be very clear. Our economy is nothing like 2008. And that's what makes it so unusual. Yeah. So why in this economy, which is very, very different, are we seeing the same things in some capacity that we saw in 2008? Well, the first thing that we go to is the main drivers of 2008, right, were a stagnant housing market that had crumbled and transactions were down. Like people just stopped moving. People couldn't buy homes. Well, today we see the same thing, but it's the opposite end of the spectrum. People aren't moving because they have equity and a 3% mortgage.
It's too good.
So it's too good. They stopped selling. And it's really bad for people trying to buy a home. Nearly impossible. Right. So these two ends of this, people won't sell and then nobody can afford to buy, has actually made housing transactions go down below what we saw in 2008. Now, one of the difference, though, that makes the hurt so bad in storage over the past 3-4 years was because unlike 2008, the times were so good before, there was mass building, right? And that where it got to that bubble that we've talked about. And the mass building put huge supply at the same time that the housing market froze, which 45% of all new tenants we get from the housing market moving, right? This led to a disproportionate effect on the self-storage industry. High interest rates then hurt not just the performance on the assets, but it hurt transactions, meaning cap rates, how we value commercial real estate, and interest rates, they follow very closely. Interest rates go from 3 to 6%. The value of the asset comes down because nobody can afford to buy it at that level. So you have the value of the assets going down, not just because occupancy and rates were hurt, but because people can't buy. So we saw huge periods of time over 23, 24, and into 25 where transactions, we're talking over 65% that hit the market were just taken off. They never even sold. And this led up to a huge pent-up demand. And a lot of people were waiting for it to change, waiting for occupancy to bounce back, rates to bounce back, interest rates to come down before they would sell. That didn't happen. Well, you go 3 years of that, and now all of a sudden there's all these people that need to sell, not just to make money, but life changes. You got death, divorce, retirement, and 2, they just don't want to do it anymore. And they've been waiting, and at some point they can't wait anymore. They're like, it's not going to change rapidly or anything, so I have to sell for real reasons. The other thing you had was all of that development that was coming online. What they underwrote when it was 3% interest rates, 96% occupancies, and rates that were going up 15% a year, it is a different world. Yeah. So when you underwrite it today, it's nothing like it was back then.
Like the flood of capital that came in, from private equity firms and, institutional investment. I mean, that also had that huge effect. Like the same thing, that underwriting aspect of like, they came in 90+% occupancies, revenues driving like crazy, like no end in sight, quotes, air quotes.
Prices go sky high, cap rates go down to a 4 cap for any facility anywhere.
Yeah.
It defied all logic. And then we had to come back down to earth. And that coming back down to earth, if you have a brand new facility, or if you're thinking about selling, that swing is huge. And so in 2008, the difference was, prior to 2008, we didn't have a buildup. So there wasn't this low cap rates. Capital wasn't flooding into the industry. We didn't have 96% occupancies. So although it went down, right, and the down was harsh, but for it, you were buying high cap rates before, right, and high cap rates kind of afterwards. There wasn't a massive swing. And that's why I say in a lot of ways, the last 3 years for storage has been way worse. Take rental rates alone. The hardest hit year we had in self-storage during that time was like a 7% drop in rental rates. And, 23 was like a 20%.
Yeah, no, it was massive.
Yeah. So it was, even though the economy is nothing like it was in 2008. Today, capital's everywhere. Unemployment is low. We have a sky-high stock market, equity in people's homes, completely different from 2008. Yet, for storage, the effect was not just the same, it was worse when you look at that spectrum. And that caused people not to sell. That caused capital to stop flooding in, firms to get out of it, values to go down, people offloading assets. And it's all fundamentally market-driven right around those interest rates. Now, what I like about that is the main drivers, right, are interest rates. Interest rates change all the time. Okay, so it's not like this is retail or something like that, where it's not just a shift on the investment side and on the price and the market of the assets, but it's an actual fundamental, like, no, we're not using this asset no, none of that's happened, right? People still use storage. Occupancies are still high, and they've been high. And when I say high, I mean, we're talking 85 to 90%, which is in the realm of normal, how it's always been. That above 90%, that was totally not normal.
Yeah.
But in order to keep that high occupancy, people had to drop rates. So people favored occupancy over rates. And that's where we got that rate crumbling. And this situation, though, is once again outside forces. This isn't like the asset, people don't want to use it, anything else. In fact, it's the opposite. More people use storage today than they did in 2008.
Yeah, and it continues to grow.
And it continues to grow. Now, what that means to me, right, and when we look at this, as interest rates start coming down and the housing market starts moving again, that creates an explosion. Lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. They're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. We have them help us underwrite deals for our students and others. They are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class. It's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. The reason why it creates an explosion is, first of all, when high interest rates went up, the speculative development and everything else got killed. The development pipeline has just gone down. That's a contraction in supply. Now, assets are trading hands. People are shifting. They're shuffling the decks because some areas got hit way harder than other areas, and that was due to oversupply. And that takes time. And this is the thing. These things are not quick. They're not fast. It takes time. But in 2025, I did a really interesting study where we looked at move-ins associated with interest rates. And I could track with a 95% confidence how many people would move in based upon a 10 basis point drop in interest rates or increase. Now, normally this would be impossible because of marketing and efforts. You're like, well, what if your marketing didn't work? The thing about this was we had a portfolio of assets that were under contract. So we weren't doing the normal things because it was under contract. So it was just pure market and we could see. That shows because there's so much capital in the system and people aren't bankrupt and unemployment is low, they're hypersensitive to interest rates. We don't need a 2008 scenario where interest rates go down to 3-4% at all. Mm-hmm. The housing market is a totally different world when it goes from 6.8 to 5.8. Like a totally different world.
Yeah.
And so as those interest rates came down, we saw an immediate spike. As they went up, we saw an immediate drop off. This gets even more important because as these interest rates are coming down slowly, the central banks, we're getting a new Fed chair next year. And the administration is the one that chooses. The administration has been very clear. They think interest rates should be like 3% lower, 300 basis points lower. That is a massive change. Now, I don't know that they're going to get that, but we could very easily see the person that's hired is obviously in agreement, or they're not going to hire, that rates do need to come down. That is going to be the primary driving reason for whoever the administration picks to be the new Fed chair, lowering interest rates. And if they're not going to do that, they're not going to pick them. So when we look at that, there's going to be huge pressure when that new person comes in to get the central banks to lower interest rates. And I could see a world where we walk in and they are not only more aggressive, but maybe they do an emergency cut. Now, with that said, we are not under the belief that interest rates are going to drop to what they were at all. But once again, they don't need to. And they're already naturally coming down. So we're on the other end of a high interest rate cycle. These things do take time. But so does investing in getting assets. Right. It marks the shift. Before 2025 and into the first of 2025, very different world where it was going the opposite way. We're on the downhill. And that's why 2025 is this important period that marks the shift. Mm-hmm. Development's down. Supply is being constrained. Interest rates are starting to come down. Housing market will slowly begin moving. Transactions will start up, right? And with that constrained supply, sellers having to sell, but still at a high interest rate, you get this effect where you're getting deals that are really good on the opposite side of this trend. And at the firm, we really took note of that. So we've been watching as we're managing assets, some that are struggling because of all the things that we talked about, also why opportunities are being presented. And we're looking now saying, okay, we're starting to see internally the stabilization. Rates aren't dropping, right? Occupancies are stabilizing, and yet we have an opportunity to buy really well. And that defines 2025 for us and what we did. We also sold assets, which is, we sold more assets this year than we've ever before. And there's an actual reason for that, which we'll get into and talk about. And we bought a lot. And so we'll get into why we're buying. Next year, we will double what we're buying. The key here is that we firmly believe we're investing personally, millions, over $10 million, $15 million personally out of our own bank accounts into these assets, into these funds that we're investing for, because we believe it's a short period of time. We do not believe after, '08, we started buying in 9, 10, 11, 12, 13, and we could just get great deals all the way through. That will not happen. This time to get great deals will be dramatically shorter.
Why do you think that is?
Well, it has mainly to do with the economy is good. People are creditworthy. They have capital, they have cash, and the amount of cash on the sidelines is astronomical. After 2008, the economy lost $4 trillion plus dollars, literally gone, vanished. We don't have that. Not only has the capital, the money supply, not shrunk, it's stayed the same or growing.
Right.
So, in '08, you had people that weren't creditworthy. You had lost capital that just was gone. And then even when interest rates went lower, people couldn't deploy it because of those same reasons. Interest rates only affect if you can borrow. After '08, they weren't creditworthy and they didn't have capital. So it didn't matter. That's why the markets froze. And that's why they had to do huge injections, everything else. After COVID, the money supply skyrocketed, hence the reason we had inflation. High interest rates, although they did slow that money supply growth down and contracted it a little, it didn't do that desired effect.
Right.
The economy's still running, it's still growing, and that has to do with a whole bunch of different reasons. But you would have thought that with interest rates going where they would have, you would have had a major contraction. That never happened. So people still have jobs, they still have money, and they're creditworthy. And that means that the effect of interest rates, that sensitivity is so strong. So when we looked at that, just a 10 basis point drop, we saw an immediate effect. Well, after, in 2010, you could go from 6% interest rates to 3% and the effect was zero because nobody could borrow.
Yeah, it didn't matter.
That is not the same today.
Gotcha.
And so it'll be very, very different.
Are you thinking in this time frame coming up that with that ability for people, that capital on the sideline, interest rates, all the different pieces we're talking about, being creditworthy, that those opportunities are just going to get bought up? Like people are going to go out there, they're going to execute on them, and
we think it'll be slow. So the opportunities will still exist.
Yeah.
Capital is way more sensitive, risk adverse, and the cost of debt is so prohibitive. But that will change much faster. So we think we have, 12, for lucky 18 months to get what would be considerably undervalued deals. Then the market will stabilize and they'll be more traditional valued. Right now, though, we're buying deals at under replacement cost in a massive way, like incredibly under what we could buy or build them for. That will go away fairly quickly. You can buy deals at really high cap rates, right? Especially when you're in smaller deals, third tier markets. Deals that are coming out on the market, they are listing at a 5 cap, but none of them are selling at that. They're all selling at way higher. And so although the listing may say, oh, I want $1 million, it's ending up selling for 800,000. Right. So we're seeing a decrease from the price that they go to the market of versus what they actually sell for 30%. And this can keep people out of the market because they just see what it's selling for.
Yeah, right.
Oh, it's too expensive, and I'm going to look. Not knowing
the listing price.
Exactly. The listing price doesn't mean that's what they're selling for.
Right.
And so we think that will continue, and we'll be able to continue to get good deals because what a asset sells for is purely based upon what the market prices it at, not what the owner wants, right? And so they may want that, but they can't get it. The difference today is over the last 3 years, people thought it was going to change, and so they were holding out. and even people that needed to sell. They're not holding out anymore, and there's so much pent-up demand from people that wanted to sell. Another thing that's happened is the last 3 years have been tough, and so lots of people want out. I mean, after 2018, you're talking 80% of funds, syndicators, or everything else are new. They only came in after 2018. A lot of those people are gone.
I was going to say, man, there's so many of those folks that I forgot even existed at this point.
Never hear from them. They're just gone.
The bee's knees back in that time frame.
We're buying, and two, then this also spurs on top of, we're talking about 10,000 plus baby boomers a day are retiring. So we're having a massive shift in assets. By 2030, we're at peak retirement. Like basically all baby boomers not only have retired, but two, we have the great die-off. And I made a YouTube video on this, and people do not understand that we're going to lose 60 million Americans by 2045. That's 60 million Americans are the oldest generation that hold all the wealth, the capital, and everything else. They own all the assets.
Yeah.
So these people are retiring and passing away. They are selling.
Right. Those assets have to go
somewhere.
They
have to go somewhere. Yeah. And then two, we have all of these people that after this 3 years being so tough, they're like, I don't want to do this.
Yeah, they're done getting beat up.
This is done, man. I bought this in 2021 and I have just been beat up. I want out. Those are the two reasons we hear. We're buying from people that are like, we want out. We're buying from people that have to retire, other things going on. And then the third one is we have to. It doesn't matter. The bank is not letting us. And these are mostly deals that were development deals. They have to refinance into a perm loan at 6%. Their underwriting's totally different. The bank's saying it's worth less. You got to put money up. They're losing money because of the high interest rates. They didn't operate storage. They were never interested in owning and operating. They were there to build and then sell it at CO, certificate of occupancy, as if it was full and make a ton of money, because that's what was going on in 2020.
Right.
And that's when they got in and started. That
these
doesn't
guys,
exist.
There a lot of these that you're seeing, they're just selling at a loss because they're like,
yes, they're losing money. Selling at a loss is actually less than they would holding on to it. So dude, they're just selling it at a massive loss.
That's so tough, man. That's a tough place to be. But at the same time, that's why it's so awesome to sit down and talk about these things and stress to you guys that those opportunities are out there and they exist right now today. You just got to get in the room with the right people and have those conversations and be in the path of those opportunities. So
exactly. This is we're talking decades opportunity.
Yeah.
We don't see these things normally.
No, I've worked with you for, close to 10 years. We're getting close to that, but, I haven't once seen anything like that. 10 years is a blink of an eye in most everything. But, it's a decent amount of time to be in the industry and to have not seen any kind of like dynamics like that.
Yeah.
Or even historically, even prior to my entering, and working with you guys, it just in
the last 10, 15 years, prices have only gone up.
Yeah. Yeah.
That's it. And now we're seeing them go down and go down massively. That does not happen very often, right? So when you have down markets, they represent maybe 20% of the entire market. And when you have down markets that are really down, that's even less. And so that buying opportunity for investors, that comes around every 2 decades maybe. And that is not only to most people a lifetime, right? Like they feel like it's a lifetime, but also what it does during that time is an explosion in wealth because the highs to the lows are so dramatic that the market itself increases the value, right? And that's where this buying opportunity comes in. And 2025 really is defined in our firm by that, and what we're buying, why we're buying, how we're buying, what we're selling, why we're selling, how we're selling. And so let's dive into that.
I was going to say, let's dive into that a little bit and kind of walk through some of that stuff in real time, because we've covered a ton of stuff, the interest rates, the opportunities, all these different things going on. So let's walk through 2025 real time. What did that look like for you guys as you're making decisions on buying, selling, refinancing, all the different options on the table. Because again, like most things, you've got in most businesses, right? You've got all the infinite amount of options and limited resources. So it's like, how do you make those decisions?
Yeah. Well, and I think we could start off with really looking at the first part of 2025 was slow. We started buying really in April. And when we started buying, we bought our first deal in April was a newer development deal. It had been open for 2 years. And it was, part of a development. Developers did a large development, and that was part of it. They were like, we don't do storage. We don't know why we're holding on to this. We just want out because this isn't even what we do. That's going to be a reoccurring thing, by the way, for us. And when we look at that, we bought this over 70,000 square foot new conversion in a main area with all this new development, everything else like that for $6.8 million. And we're looking at a stabilized value. And that doesn't say whenever I say stabilized value, everybody, I'm not talking about interest rates going down. I'm not talking about values going up and cap rates going down. No, stabilized as in today stabilized, right? I talk a lot about that money on the table. So occupancy plus normal market rates that we see. Today's rates.
The knowns.
We're looking at like $9+ million. And that continued. So July, we went and bought a brand new, beautiful facility, about 70,000 square feet for $6.3 million. And we, at this location, everything else, we couldn't build it for that. This only started to get better. By August, we bought another one that was 70,000 square feet, $7 million, right? And so you see this $6 to $7 million range, Well, then we moved into 2 that we bought that were over 100,000 square feet. And these 2 represented, one was about 8.5, the other one right around 9.5 million. These are multi-story, Class A on the freeway, growth rate cities that have incomes over 100,000+. And it would cost us, let's put it together, say it's 17 to 18 million, what the price tag was. There's one of those today would cost us to build probably around 15 million to build one of them.
For sure.
And the people that build them, it's not like they did something wrong.
Yeah.
It's just the market.
Well, and you're
Interest
talking
rates went
like institutional grade assets.
Oh, these are some of the nicest facilities I've ever seen or bought.
Yeah.
Top of the line. And it had nothing to do with them. It's just the timing. And they weren't storage operators. They didn't do that. They didn't have professional management in it. It was just one was just operating it, right? And they're like, hey, we got to get out. We don't have a choice. And, this happens. So we're looking right around about 400,000 that we'd bought so far. Right now we have square feet, 400,000 net rentable square feet. That 400,000 net rentable square feet cost us roughly 36 million. So we're averaging under $100 a square foot into assets. The building would be 150
for sure.
And that's just to build it out of the ground. We're not talking about sell. We have under contract probably around 50 to 70 million more today that will end up closing in January. And so we'll probably double that next year. But most of these came August and after. That's where, July, after July, that's where 80% of our acquisitions came from. So it started off slow. We didn't even make the first one until April.
Yeah.
And then by July, August, it was and it just ran from there.
Interesting. Do you think that was more of like those opportunities were just hitting at that point in time because of the position that the sellers were in, or was that a product of like you guys ramping up and then focusing on that more, and then those opportunities just...
It was the opportunities hitting.
Yeah.
Okay. And I think it is 2 things. I think a lot of people were waiting for the busy season to come, and they're like, oh, occupancies and rates just going to shoot up and put us in this great position. Our interest rates are going to go down,
Yeah.
It didn't happen,
Nothing
right?
moved.
And so I think finally after years, people are like, okay, we're done.
Yep.
Like, we're done.
Times now, dude.
Times now. We got to make that choice. We got to figure that out.
How did you guys, I mean, you talk a lot about being the bear and being the path of opportunity. How did you guys, and how are you finding those opportunities, those distressed developers or people that are just, they're in it, they're developing it, they just go in to build and sell. Like, how are you guys finding those opportunities?
So first of all, I may be talking about big deals, but we can look at the community as well. And out of the people in our community, the amount of acquisitions that have taken place in the last 6 months on $500,000, $300,000 deals, $1 million deals has just spiked.
You're talking the self-storage income community.
Yes, because we bring deals right to them. And so when looking at that, the deal flow just went. We brought 50 plus deals that were like, these are amazing deals, right, to buy. And those opportunities really built up after summer. And we will easily double that in the community this year.
Be
easily. The flow coming in is huge.
I mean, a number of people I have on the one-on-one sessions, dude, so many of those people have deals under contract or have closed on deals this year. It's been bonkers. I've got one guy, he's just crushing it, doing great. I mean, he's got a portfolio of them in a market where he's going to be able to go in, consolidate about 70% of the market share there. Crush it.
He'll own the
Just
market.
Amazing.
And that is, we're talking 3x the year before, 4x maybe. I mean, the amount of deals. And so
it's incredible.
Even when we're talking about small deals, and some of these are just, 8 to 10 caps, right? Far below replacement cost. There's no deals. There's no development coming in that they're able to get. They can use SBA loans, right? And it really does come down to this shift over the last 3 years from finally we got to sell, and it's finally I'm retiring, something has to happen. The deals that we see and are getting are twofold. So once you look at the last 4 assets that we bought were directly to us, for us. I mean, I want to sell to you. Off-market deals that we had made, and then broker relations. So the other ones were from brokers. And so when we look at that makeup, probably about 50-50 from off-market deals, brokers. That changes wildly. So if you go back to 2020, it like 100% were from brokers. Because everybody just sold from brokers because they're like, oh, they'll bid it up and we'll get a high price. Everything. That's not happening today. And so people are like, if it falls out under contract, so if you put a deal on the market, it doesn't sell and goes off, and then you want to relist it 6 months later, the price is going to be lower. So people are super scared that it's not going to transact and that they're not going to get the price and that it's going to be lower and they're losing money or they don't want to do it. They don't want to deal with it. Also at lower prices, they look at that broker fee as being a cut from them. So they're going, why am I doing that? Some of these people that were buying did put it out to market. They brought it off market and now they're like, we're not going back out to market again. That didn't work. And so we have a lot of people with us in the community that have relationships that they've been building up. And we teach people how to do that. We teach it here on the podcast, and the YouTube videos, and then we also deliver those deals to our community. That's why they're buying them. They're buying the deals that we bring to them, and that is through those relationships and connections that we built. It's not an overnight thing. It's not like, once again, we talked about listed price.
Yeah,
I'm not saying, oh yeah, somebody listed a deal at 50% below replacement cost.
Right.
No.
Never.
No, that's not how it works, right?
Deals are made.
Deals are made. They're not found. Yeah. And if they were, everybody would see it.
Yep, exactly.
Everybody would know.
Yeah.
And 2, they don't want to go out to market at that price. So building those relationships is really, really important. Both brokers, off market, and then like our community with the community. They're doing deals with each other, selling. Like, you need to be in the position, right? And that's what the be the bear concept is all about. You are in the position to where opportunities are coming to you, not out trying to find a good deal.
Exactly.
You're in the place where deals come, and then you can create them.
Yeah. I mean, we've had even people question whether or not they're doing things right, where they're like, man, I'm underwriting these deals. I can't find anything that pencils, that works. It's like, You're not going to.
You're just looking at the listings.
Doing great.
Yeah, exactly.
You're doing everything right. Submit the LOI, guys. Throw it out there. Get after
the
it.
amount of deals we look at is crazy. It
Yeah.
takes time,
Yeah,
right?
for sure.
That's part of it. If it was just super easy, everybody would do it. That's
Well,
not how
you
it
guys are
works.
sending out a ton of LOIs.
Tons.
I mean,
Yeah.
tons of these things. I don't know how many a week or a month, but it's far more than I think a lot of people would realize
Absolutely.
or assume.
We are working with owners. We're working with brokers. We're seeing hundreds of deals, right? Now, we're buying in magnitude. So if you're just trying to get one, maybe it's not hundreds or thousands you look at, but I mean, people are like looking at like 4 or 5 deals. They may say, I looked at 100 deals, but all they did was look at a website. Here's what it's listed at. That doesn't work. That is not looking at deals,
For sure.
right? That's not what we're talking about. I'm talking about working with the brokers, being in the communities, being out there talking to owners, actually looking at the deals, underwriting, figuring it out, right? You want to get one good one? Yeah. And you've only looked at 5?
Yeah.
Of course not.
It's not going to happen.
No, it's not going to happen. It's not how it works. So that's where that work up front happens.
For sure.
And needs to happen. And 2, that isn't a representation of the time. That's how it always works.
Dude,
and I think
love
people
that you
forget
hit that. Yeah, because nowadays with technology and the mailers and the phone systems and all the things that people are using to try to find opportunity, like I've been telling everybody, I'm like, dude, there's nothing that works better than putting faces to names, shaking hands,
Absolutely.
going to lunch, going to somebody's facility. Like,
If you need one deal,
people, dude.
that's it.
Yeah.
Do that.
Yes.
Meet people, build the relationships.
Yep.
It's not a volume game.
exactly.
You're looking for one good deal.
Yep.
Right?
Dude,
Your,
money.
your outcome, your close rate will be astronomically higher. Right?
100%.
And you will get opportunities that other people don't see.
Exactly, dude.
Now, let's talk about selling deals.
Yeah, I was going to say, I really
Yes.
want to dive into this, even for my own insight into how you guys made this decision. Because so often, I mean, you guys were in like that buy and hold mode forever. And now
Yes.
it's like, hey, actually, it makes more sense at this point in time, instead of refinancing, to actually sell. And how you guys made those decisions. Super, super excited to dive into this one.
So, first of all, I think when we're looking at actually acquiring deals, we're really trying to get to a stabilized yield of 9 to 10, right? That's kind of like we
that's
want
yield
a
on
9
cost?
to 10% yield on cost.
Yeah, okay.
That's kind of our mark. Now, when we look at the selling of deals, and I have a chart here. If you're on the YouTube, you can see it. If not, don't worry, I'll explain it. This chart represents a portfolio that we just sold for around 100 million. And it shows when we bought them, when we refinanced them, and when we sold them. Now, the key is the acquisition time frame is spread out. But there's a middle time frame that when you go to really 2000 starts at 2018 to 2022, those timeframes, which is our refinance timeframes. What had happened is we're buying those deals. We increased the NOI because markets got better. We were able to get rid of delinquencies, increase occupancy, do rate management, and then interest rates went really low. So we could refinance, take our money and profits out of it, not increasing the debt. So we didn't just go and put more debt on it. No, what had happened is as they improved, we were at a period of time where our debt to equity was like 30%.
Yeah, I was going to say, you guys maintained like 70-30 always or something.
Yeah. So we wanted to refinance at what we had bought them for at a, 70-30 or, lower 60-40.
Yeah.
And by doing that, we could take all our money plus profits out of them. And then if you look at from there to, the end of this year, we actually had to sell. Well, why did we sell? The opposite had happened. And now interest rates went up, but at the same time, we'd increased the value. So what I'm talking about here is equity conversion. Why did we make that decision? First of all, the amount of equity that was in the deals was so big compared to what we were actually getting for them. Our return on our equity was really, really low. So if we took that equity out, especially in today's market, I can buy deals that aren't maximized, optimized, and I can use that equity to buy more and get an actual higher return, and then also have deals that have upside. So we wanted that equity out to put it to work. But refinancing, we were going to get nothing because interest rates were so high. It's all about that debt coverage ratio. And interest rates kills that debt coverage ratio. Now, one of the things that we did if you guys, everybody remembers, I talked from 21 to 22 about that self-storage bubble. And when I was talking about this, I wasn't just talking about it. We refinanced our about 10 assets. We put those 10 assets into a long-term debt structure at a 4% interest rate.
The CMBS or something.
Yes.
Yeah.
Non-recourse loans. And the reason we did that was because I was like, this is going to change. We're in a bubble. This is all going to change. What that did then was all of a sudden, 5 years later, 4 years later, we have a portfolio of assets whose interest rate is 4% locked in because it can be assumed. That meant we were able to sell at almost a 4 cap because the person getting it, their interest rate isn't 6.5, it's 4.
Yeah.
And so when we look at that, what we were able to do is pull our money out. That allowed us to have money and cash on the table for when times were going to get bad. Then it also locked in a low interest rate, but then all of a sudden it put us in a position where we could sell these assets. The buyer's getting a great deal because they're getting interest rates that are impossible to get today.
I think that's such a really good point to highlight is securing an interest rate and
Yes.
and seeing that as a valuation play on an exit. Because I don't think a lot of people look at that. I think they're looking at their debt service, like what am I paying every month and every year, and how can I, maybe I want to secure my interest rate to make sure that I've got this like devil I know kind of thing, as opposed to some variable rate or floating or whatever. I think a lot of people look at it that way, as opposed to looking like, how does this impact the exit? And I think that's so important to be looking at.
Yes.
So that's awesome, man. Thanks for sharing that.
The asset wasn't just the real estate, it was the financing product.
Exactly.
And that gave us a really high valuation. And it's great for the new owner.
Yeah.
They're locked in at this low interest rate, all improvements that they make, they know it's fixed. They couldn't make it, under it. So it worked out for both parties. It gave us a huge amount of equity to go back and reinvest. And so now we've been buying up deals like our fund that we have open now with some of these deals that I was talking about, the 17 million that would cost us 15 million to replace, right? We're putting our money into it. So we're putting 10 plus million in, and investors are coming alongside us. So it put us in a position where we could survive the hard times because we had cash on hand when everything was struggling and other people were leaving the business. But then it also put us in a position to where we could sell, have a great product, and put that money back to work. That is essentially the exact same thing we did when we made the acquisitions. During that downturn, we sold assets that were abnormally high, and we rolled them into that period of, 2000 and, 11, 12 to 2015, really, where we could roll in and get assets that were undervalued. And then that made that portfolio, then we had refinances and sell, we're talking about a 7x multiple over that. And that's, that even too is a high amount because some of the assets that we put in, like on the books, it looked like we put in way more money than we did because we bought the land at $150,000, but then the land was valued when you underwrote it at like 2 million. So it actually, it's a higher return than that because the amount of money that we actually put in was lower. But from the book value of the assets brought in, right, it's higher. So that allowed us to make multiple capital events where we could make money off these deals. We refinanced, I think, twice those assets and then sold it. And now we can buy underperforming assets. And then we can optimize and ride them up. That is the wealth cycle.
No, that's amazing, dude. And is there, because you're shifting this focus to that return on equity, and I mean, you've got a lot of REITs and professionally managed folks out there that are in that buy and hold mode. Are they focused on that equity conversion?
Some of them are, some of them aren't. It's a pure cash flow, thing. They're looking at, They don't want to sell, they don't want to do it. So it really depends on the firm. And for us, remember, we held these things for a long time and never sold them.
Yeah, for sure.
If we could have kept refinancing and getting money, why would we sell it? Because even if we sold it after taxes, everything else, if you have a good refinance, it equals the same, yet I still own the asset. That's why we refinanced them before, which thank goodness we did.
Yeah.
We got all our money out plus profits, and then they essentially doubled.
This is cool because you can see that real time. I mean, you've talked so much about the goal stays the same, the vision stays the same, but that path to get there can change.
Because
perfect example.
Exactly. The goal has not changed. We didn't sell and just take money out. No, we sold and we reinvested it back in.
Yeah.
So we own more, better assets, bigger assets, and these assets have upside that are far above the ones that we sold because we done our strategy and maximized them. And then we're going and buying ones that can yield exactly the same like these did with that outcome.
Yeah.
And so that creates our money, getting us, the same return because we buy more deals, but then have the upside. We enter in more markets. And this has been the process that we do it. And then obviously we're teaming up with investors and everything. That makes our money go more. So I can buy more deals with my money. Investors are coming in, riding alongside me. I can buy more deals. So it works out for everybody. And then we have the same thing will go on. So maybe we buy all these deals, but then in 5 years, these deals that we're buying at below replacement cost, we have a 6.5% interest rate. All of a sudden that's 4.5%. The cap rate has dropped. Our valuations that we look at don't include any of that. It doesn't say, when we're looking at our conversion event in 5 years of equity, we're saying cap rates are the same and interest rates are just as high. And market rates on the units haven't gone up.
Right.
Well, of course, we know we obviously firmly believe that will happen.
Right.
These things go in normal cycles, but we don't underwrite it for it. When you underwrite that in, it's just like happened before, an explosion in wealth. But we're conservative going into it, just like we were then. And that magnifies those returns in a big way.
Absolutely. Do you kind of have like the conservative, like, hey, this is what we're going to plan everything and execute everything based on that conservative underwriting?
Yes.
But then we pretty much know underwriting.
That this is going to,
how it's going to go.
We do. We don't show that to investors.
Right, of course.
We look at it, we keep the conservative one, and then when it's twice as much, we're happy because it also goes the other way. When you're talking about this time frame of deals that you bought from 2020 to 22 or 23, it happened the opposite way. So we really got to look at that and be like that. And two, you don't escape those market cycles.
Right.
We're all in it. I got hit in it. Everybody got hit in it.
For sure.
It's whether or not you can survive, you have it set up right, and what you can do to wait it out, right? And wait for the cycles. I can't control the market.
Yeah.
And people that think they know what the market's going to do or think that they can control them, they're going to get hit. And that's what happens when you're like, oh, I'm just going to sell this at CO at a 4 cap in 4 years. I don't know what the market's going to do in 4 years.
For sure.
But I do know that we're at the opposite side of what the market was 4 or 5 years ago. So right now, when you look at fundamentals, the fundamentals are really, really good.
No, that's amazing, dude. And then, talking all this stuff is fantastic. 2025, incredible things going on, positioning your guys' selves to capitalize on some amazing opportunities here in 2025 that you guys have done. But 2026, what's the outlook?
Yeah.
What do you think is going to happen?
2026, we're trying to hit the ground running really, really hard and buy lots. Our hope would be by summer, minimum what we did in 2025 in the first 2 quarters. Now, we expect and look at our current existing assets and everything that spring will be a much busier season. How we come up with that is comparing interest rates and the housing market, which is in a much better position today than it was then, and way better than the year before, and so on. So we have a natural progression here. Once again, I don't need the housing market to boom. We're not saying any of those things. I'm not saying that interest rates are going to drop, but interest rates going from 6.8 to 6 is a huge difference.
For sure.
If it goes to 6.5, that's another, or 5.5, that's another world, right? And so the housing market, as we look at it, prices have softened As interest rates come down, people will be able to move, make decisions, but you also have baby boomers that are going to sell, and there's other things that happen. So that frozen market that's happened over the last 3 years has created a lot of pent-up demand. We are now seeing starting down the other side. So that also is combined with storage development. We're in markets where storage isn't being developed and hasn't been. So while those things are happening and the market's starting to unfreeze and starting to get better, we have pent up supply because supply is not coming on because development's really bad. And that then further exaggerates how that will turn out. So we think 26 will be a real turning point. 27 and 28 will be really good. And so 25 was the change. That tipped the scale, right? 26, we're going, all right, now we're going to start to see an upward lift on fundamentals. After you have upward lift on fundamentals, that starts to attract outside capital. So, occupancy and rents went up.
Yep.
Fundamentals are getting in. Then outside capital wants in to ride the wave. And then that starts to push cap rates and everything down. And you're on that other part of the cycle.
Exactly.
And so then it builds through 27, 28. As capital comes back in, people are buying. There's less demand because you have less storage facilities being built. There's pent-up demand. Occupancies rise, rents rise. Interest rates come down even just a little. The housing market unfreezes and there's some housing transactions, nothing like we've ever seen, but you don't need it because we don't have supply even keeping up with it.
Man, I'm so excited. I'm so excited to see this stuff playing out in real time. It's been a long time coming.
It's been a long time coming. And it has been a hard 3 or 4 years.
Yeah. Well, and I think that's another really, really good point to hit on because so often we talk about these things, businesses not being ATMs.
They're not ATMs.
There's going to be the ups and the downs.
Yes.
Build those freaking reserves. Position yourself. Be hard to kill. Like, don't get in there and think that you're just going to have this ATM and things are going to just continue to grow. Value is going to be going through the roof. You're just going to be, depositing checks nonstop and just rolling in the dough.
The biggest and the best business are the ones that survive.
Yeah. Yep. Exactly.
And that is just the truth. Down cycles for any industry, when they go into a down cycle, it wipes out lots and lots of people. But then it exaggerates the upside because of that on the other side. Every industry does this. Every stock market crash, every change in ownership, right? It is a wealth transfer. And the ones that can't survive the downturns, they're gone. And that leaves opportunities for the ones that survive, and then they get the upside.
Exactly.
So the best businesses are not the ones that are the most technically advantaged necessarily or anything like that. They're the ones that survive.
Exactly. 100%, man. Couldn't have said it better. Thanks, everybody, so much for tuning in. Fantastic info.
Let us know in the comments, guys, what you're seeing in your markets, opportunities, because in self-storage, every market is different and it's market specific.
Yep.
So let us know what you guys are seeing.
Love it. Thanks, guys.